Vietnam. The next China? Vietnam is one of the fastest growing economies in Asia. In 2010, Vietnam was the second largest exporter of garments and textiles to the United States and fifth largest globally. Vietnam has also increased its machinery investments in parallel with its increasing textile and garment production. The development of seafood processing industry has made great contributions to promote agriculture and fisheries development, thereby making positive changes to rural areas, creating more jobs and higher incomes for the locals. The 2009 statistics showed that seafood industry accounted for 4% of the nation's GDP. Vietnam has also been increasingly investing on greener and more advanced production technologies to meet the international requirements on social responsibilities and environmental protection. The fisheries industry targets an export turnover of $10 billion by 2020, transforming Vietnam into one of the largest seafood traders in the world. Vietnam is also one of the largest exporters of agricultural products. Vietnam is the second largest rice exporter. It is also currently the fourth largest rubber exporter. Vietnam ranks 7th amongst the world's biggest tea exporters, and is also one of the largest exporters of pepper, cashew nuts, peanuts, and soya beans. Vietnam also exports lots of fruits and vegetables, with China being the largest export market of Vietnam's fruits and many other goods.
Due to rising costs, labor shortage, and policies discouraging low-value industries in China, more China enterprises such as textiles and apparels are constructing factories in Vietnam for its lower costs and more favorable trade policies. Many international corporations are adopting the China Plus One strategy by setting up a second or third production base outside China, particularly in Vietnam, so as not to be at the mercy of fluctuations in China's labor and resources market. Companies such as Canon and Nissan are moving their productions out of China into Vietnam. Because of this, Vietnam's GDP per head increased from below $100 in 1990 to over $1,000 currently. Monthly salaries in Vietnam are about 3/5 of those in China. China intends to gradually increase wages by 20% yearly, doubling the minimum wage by 2015, further widening the labor cost gap between China and Vietnam. It is definitely tougher and more expensive than it was 5 years ago to enter China with a low-end, high-pollution factory. China is no longer charging lower corporate tax rates for foreign-owned companies. During the first half of 2009, the tax revenue from non-resident companies increased by more than 40% as compared to the same period in 2008. Lesser tax incentives in China also make foreign corporations think twice about tax implications and feasibility of setting up operations in China. By contrast, Vietnam offers foreign investors 0% corporate tax rate for the first 4 years and half the usual 10% rate for the next 4 years.
Moreover, Vietnam has established regional economic integration with ASEAN, which has enhanced trade for Vietnam. When it became a member of ASEAN in 1995, Vietnam implemented open-door policies and conducted progressive trade and investment reforms. This led to a rapid increase in trade, making Vietnam one of the most open economies in the region. Regional integration with ASEAN helped Vietnam gain access to vast regional and global network. Free trade agreements which Vietnam has established with ASEAN, Japan, China, and Korea help her develop regional supply chains and expand business opportunities. The opportunity to learn from their experiences in economic management and businesses will assist Vietnam in building an efficient, dynamic, and competitive economy. However, we cannot disregard the problems that may hinder Vietnam's growth. Regional integration may cause domestic producers to face increasing competitive pressures from regional imports with reduced tariffs. Competition for foreign investment will also reduce Vietnam's competitiveness over China. The size of the labor force and infrastructure may restrict how fast China Plus One can expand. Vietnam's population is 16 times smaller than that of China's. The cost of workers and goods will increase as new foreign investors enter Vietnam. The lack of traffic control in Vietnam also slows down shipments and drives up the cost of production.
Will Vietnam be the next China? With an increasing trend in Vietnam's trade output, it seems that Vietnam may even surpass China in the future. Woo!